It has been a rough few months for the dollar. The dollar index at one point hit its lowest level in 2 years. The question is, what it wound up meaning for the Treasury market? Take a look at this chart, and Neil Dutta of Renaissance Capital says, look, the lower the dollar goes, the more appealing U.S. Treasuries are going to be, and in theory, going to stabilize yields here. Well, Steven Major of HSBC is still with us, and he has the lowest call on the 10-year yield at 1.9%. Walk me through the knock-on effect of that weaker dollar and the Treasury market.
Well, I wonder whether the weaker dollar is just telling us the same thing that the Treasuries have been telling us for a while, because actually the facts are that yields have been falling since the start of the year. The expectations of a move towards 3% never happened. So the Treasury market and the dollar are both reflecting a weaker economy and the fact that the Fed is getting very close to the end of the tightening phase. The other thing to bear in mind here is that the rate differentials are sort of the cyclical explanation, but there's a political angle perhaps as well, and a more structural story that all supports the trend in the dollar going down.
So walk me through then what it winds up meaning for the Fed, because Ellen Zentner, if I remember correctly, of Morgan Stanley, for example, sees 4 rate hikes in 2018. So some economist estimates in 2018 are still holding up pretty well in terms of hikes. What do you see that's different?
Well, I wish them luck with those forecasts. I doubt it's going to happen. I mean, we're not forecasting much more from here. Perhaps one more next year is possible. But the fact that the Fed has been very clear about their intention to start testing the runoff, which I guess is a third quarter event, which could happen by the way at the same time as the debt ceiling and the ECB running a taper. So a gentle test of the runoff probably means that they don't do anything with the Fed funds rate at the same time, because they want to see what the implications of this shrinkage of the balance sheet might actually mean for global markets, not just the Treasuries. My view is that it's going to be quite benign for the Treasury market. I think yields will keep sinking to reflect the disinflation pressure and a recovery that isn't as strong as some at the Fed want to talk it up about. And so I think that I have a completely different view to those who are saying 3 or 4 hikes from here.